Hello and welcome to NavTalk. NavTalk is proudly brought to you by the Navwealth Financial Group, helping you reach your destination in life on purpose. My name is Simon Prowse and I'll be your regular host for this series of podcasts. And I look forward to bringing you interviews and content on a broad range of topics. Topics that will be educational, inspirational, informative and at times fun. Well, hello everyone and welcome to today's NavTalk. So you want to sell your business. I'm here today with Peter Hickey, an entrepreneur and business owner, or former business owner in your case, Peter. And we're here today to talk about selling your business. How are you, Pete?
Yeah, good. Thanks. Nice to be here, Simon.
Before we get into planning or selling a business, why don't you give us a bit of a story about your businesses and where you got to? I think you've had a couple over the years.
Probably I've had a couple of different journeys, as you mentioned. The first journey was one of total uneducation in starting a business, running a business and selling the business. But I started the business up. The business model wasn't quite right. We adapted the business model. We built a consultancy firm. The consultancy firm we wanted to scale. And so we built some really good tech around that consultancy firm. And we developed some technology that we started to market to business owners. And we were fortunate enough to leverage one of the largest banks in Australia, do seminars and workshops around Australia. We started off selling, sort of 5 units, 10 units, bringing it in, importing it. Then we created our own product. We ended up scaling it and moving up. We ended up shipping about 40,000 units of software. And I managed to sell that, and we'll go through that in a second, but I managed to sell that to a multinational. $4 billion multinational. And I walked away, and that was sort of like the dream, starting a business from scratch, building it up and selling it for millions and then walking away. And I walked away and tried to settle back a bit, started another business. And in the end, the multinational, the market was at the peak when I sold the business. The market was deteriorating. The multinational stuffed up the business, and I ended up buying the business that I'd sold back for 5% of what I sold it for.
So this is the first business that you ended up buying back from that multinational? I ended up
buying back from that multinational. And then, the second time around, more savvy on both running a business and on selling a business. And I built that up with a different type of business model, more of a lifestyle business, but one that was highly profitable. And I ended up moving that. And we got to a stage where I just wanted out. And so we looked around the marketplace and I was able to sell that to a private equity company from the US. And I walked away from that. And now I've just set up a new business as well, which is a completely different type of model and business as well.
So, Pete, you're in the business and you're running it and it's growing and it's growing to plan. I'm assuming you're enjoying yourself. What made you decide to think about exiting in the first place?
Yeah, it was an incredible thing. We got to a stage in the market, Simon, where we were growing. When you said it was an enjoyable process, running a business, we were scaling at pace, and I wouldn't call it a highly enjoyable business to run. It was quite a phenomenal. There would have been, probably every 3 months I'd have the house on the line. Because we were scaling so fast, didn't have the capital behind, never had any capital backers. Now, there was good and bad about that. So the good was that I had 100% equity in the business. The bad was that all the risk I put on myself. And so it was good. And I went from an uneducated business owner to educated. And so what happened was that I just dreamed in the back of my mind that one day I'd sell the business. But it wasn't really at the front of the mind. It was just there, imagine if I could. And I still remember sitting on the balcony with my wife, and this was saying, geez, imagine if we could one day sell the business for $1 million. And we had no idea how, wouldn't even think of how I'd put a plan together. I'd have no idea on any of that stuff. Anyhow, 2 years later, I started being approached by everybody, and they were offering big money, many millions of dollars for the company. And I had no idea I didn't even know the terms they were using. So we then engaged one of the big 4 accounting firms to have a look at trying to sell. So the market was going berserk. This is the IT industry, was going berserk. The valuations were going through the roof. And they at least went through, and paying the money for an advisor was absolutely fantastic in that case, because they sat down and they said, it's about a process. If you're going to sell, you've got to get ready to sell. And what they did was they did this journey with us of preparing us for that exit, which was absolutely great. And then they took us to that. Then they went out and they approached the market. They got indicative offers for the company. We went through a due diligence phase. And funny enough, with all of that, we had one of the biggest software companies in Australia at the time that had just floated. They were huge. They'd put in a really good offer for our business, and but it fell through in due diligence. I was depressed. We looked at floating the business, which was we saw brokers and all the rest. And but I was really depressed. The staff were a bit annoyed because I'd promised to give them a chunk of the money that we'd built up as well. And then I negotiated with a multinational that came on the street in the market about a year later. They approached us. I negotiated for sale myself, and we ended up selling for double of what the previous sale was. So it was a phenomenal success story that we had. And it was, but I wouldn't have been capable of negotiating with a multinational on the sale of the business if I didn't understand verbatim what we had to go through. And that's the benefit of the process and getting that advisor in place to start off with. It put us in. And some of the things we did, Simon, to get ready for sale, it almost would have doubled our business value, just doing the right things. And even in the due diligence process, if you haven't got all your ducks lined up, if your management financials don't fit, and and we were out of control as a growing company in the beginning, we had to get in control on a sheet of paper. We had to get our systems in order before we sold, and that's what that preparation and build up sort of phase was.
I'm going to go through a couple of areas through what you've just mentioned, Pete, which is fantastic. So firstly, you actually weren't out on the marketplace saying we're here to sell. You actually were being approached at the time, which is interesting. How do you think that came about? Was that just a symptom of tech at that moment, or how was that happening?
Yeah, well, and that's a good question, because that's different to the second time I sold, which was completely the reverse. But the reason why we were approached by so many people was that everyone thought, so we had 30 staff, but everyone thought that we had 100 staff. Everyone thought we'd sold 40,000 units of software, but we were spending $100,000 a month on advertising. I was all on brand. There was not enough small business magazines for us to advertise in. We were in the airline magazines, the small business magazines. We'd spend about $60,000 on, a month on those sort of advertisements and direct marketing campaigns. And then we spent a lot of money on fax marketing as well. I think we were sending off 1 million fax broadcasts, in our country a month, so it was, so the answer to your question was we built up a brand, everyone. And we did some research, out of the top 100 companies, 92% had our product. That was only a $300 product or a $500 product, but we'd sold to just about everyone, and when we did some research, there was something like 3 out of 5 business managers over the age of, say, 35 or 40 knew our brand name. And that's how much we were advertising. So we were in and it was just a lucky time, Simon. We were in the market was going berserk. People were looking for good quality, IT businesses. And because there was a lot of stuff that was pie in the sky stuff from a lot of other businesses. We were sort of like a bricks and mortar. We had good cash coming in, good sales. We had a huge database and a great brand. So we were primed for the taking.
So your presence was a lot bigger than it really was. You were punching well above your weight, but you had a significant budget on that and knew by challenging that was where you were. Take me through that process in terms of the due diligence and what you learned around that. So you've been approached and you decide that, okay, we're going to look at these offers and really take it on board, and you called in the advisors. What happened through that process, Pete?
Well, I think that's the thing that I learned, that we were talking to other companies about merging and floating. We were talking to other companies. We'd had some people saying, "Are you interested in selling?" And I was totally naive. And so that's when I called in the advisors. It was one of the big 5 accounting firms. And so what they did was they did what we call a reverse due diligence. And so before we sold or went to the market, they came back, and the first thing they really started doing is saying, "Hey, Pete, when do you want to sell?" I go, "Well, I'm quite happy to sell now if we can get enough money. How much do you need? So are you going to retire? How much are you going to need for the next part of your journey?" And so the first part was getting me ready personally, and equipping me with, if you like, the right understanding of what I needed, what we needed to do, what the value was. And I think so I could have a good conversation about educating me on how businesses are valued. And then we sort of came back and had a look at the business. Said, "Well, look, Pete, this is a phenomenal business, but I've got your management financials here, and they don't, they really don't, reconcile back well with your tax financials." And so there was a whole process here. And, you're saying you did this much volume of sales in this product, but that's a little bit different to this report over here, but it's different. And so our reporting systems were all well-meaning, but some took in returns, some didn't take in returns, some were poor, some were done by sales reps which weren't good, and some was done by an accountant which were perfect, but they didn't sort of equate back. So we had to really make our financials or just legitimize our financials and everything together. And we had to put the right systems in place. So we had some good systems, but we just had to really back those systems up and have some better reporting from them. There's a lot of stuff we had to do. We had to make sure a couple of things. We had no IP ownership from any of our advertising or design people. So we had to go back to all of them and say, "We own the copyrights of what you've got." We didn't have employment contracts that were suitable. So we had to go back and revise our employment contracts and make sure that everyone signed them. So so if a multinational is going to buy you, they need to make sure that you are not going to cause headaches down the track. So they need to buy a good, solid company. And the multinational that bought us, by the time they bought us, we were fantastic. They had to try to buy us a year before. It all would have fallen down. The value would have been wiped off the business, and they probably would have walked away.
So you can't underplay this due diligence reverse due diligence, then, Pete. It sounds like it's pretty fundamental if anyone's thinking about selling.
Yeah, absolutely. And the interesting part is that the reverse due diligence also has to look at, and in my case, it looked at what I wanted to do afterwards. And there was a product that I developed. It was a product called Business Olympics, which was a simulated training sort of game. And so that wasn't making any revenue for the company, but it was a lot of IP that we had. So we decide in our letter of offer to everyone, or our sort of information memorandum it's called, we made sure that was excluded so that I could use that afterwards. We also made sure, because there were going to be embargoes over what I could do when I sold the business, we made sure that there was a clause there saying that I could conduct training and consulting and I could use that, etc. So for me, we had to, and I did that the second time I sold the business as well. It's very important that for me, and it's very important for other business owners to really think about what IP do you want to retain or would be excluded from the sale, and maybe we've got to get rid of that beforehand, so and take it off the books so it's not included in the valuation, and it wouldn't be an expected part of the business assets.
That's really interesting. So by talking personal readiness, you're actually saying, well, what do I need for the future, and isolating that, in your case, this Business Olympics, from that actual purchase and sale. In the reverse due diligence also, is it fair to say that you learn a lot about your business and it actually drives you to make a better business in that process?
Yeah, absolutely. I think and I found that as I build a business to sell, I had to build a more systemized, more streamlined, better planned business that was less reliant on me as a business owner. And by doing so, I built a far better business. And it really is, everything that you're doing is just really building the systems, the processes, and even the hierarchy to take the business on so you can exit, sort of without the business, going down. And I think that's important for every business owner because, what I've learned the second time around, the first time around I was working, I can't tell you how many hours I was working, like night, days, weekends and that sort of stuff. Whereas the second time around I was very rigid. I wanted to run a business where I was working, sort of a lot less hours. I wanted to play my golf or do whatever I want to do, and that was most important. So in order to build a business like that, you've got to build people in place and systems in place and your expectations in place so that you can achieve that.
So not reliant on the business owner, reliant on the business, which in effect adds to the goodwill of the business.
Yep, absolutely.
Tell me, there are a number of ways to exit a business, and in this due diligence process, did you look at those ways? You mentioned before, do a joint venture or a merger or things like that. Was that part of that process? Yeah,
absolutely. The options that I looked at was one was selling the business as a trade sale. And to me, it had to really be a multinational type business, which is why we chose one of the big 5 accounting firms because they had contacts overseas. But the other thing is, as you mentioned on the journey, it was really having a look at people approached me on a merger. So could I merge with somebody else? We were approached by these private equity companies that said they could get us an IPO. The way they would do that would be to merge us with another company that would be capitalized by them. So that was really interesting. I can't tell you how much I learned over that period just on how, I just didn't get this stuff. I didn't get the multiples and all this. And even today, some of it's just really above my head. It's that high level stuff. But I just understood enough about the basics of valuation, and in the end it was a trade sale that was effective for me. The second time, so I've just exited the business for a second time, as you mentioned. I'm at a different stage of my life where I'm 60 or approaching 60, but I've also got kids that are in that sort of young 20s. And one of the things that I've sort of looked at before exiting the business was whether or not it would be, possible for a family succession to leave a legacy. And basically, I think the answer from the kids was, "Dad, I've seen how hard you work. No, thanks." But I think for me, as a business owner at a different stage of my life, there's been exploring different options. And you got to remember, the first business was an aggressive, high turnover, high business. The second business was much lower turnover, much more profitable, better lifestyle. So my exit options were far more limited in some way, but the age meant I was reflecting on other options.
Oh, that's fascinating, Pete. And in those exit options or understanding the alternatives, did you have a clue of what the business was actually worth in terms of you getting, randoms saying, "I'll make you an offer," but did you know the value at the point?
First time around, the market was berserk. There were valuation multiples. So any business is, and this is one of the things that I learned, is basic valuation is you get your profit and you multiply it by a certain number. So the first thing is, what is the definition of your profit? And it's sort of, I didn't realize, but it includes a lot of the money that you're taking out of the business as well. And you multiply it by a certain multiple. Well, those multiples, Simon, were just all over the place. Like a standard business in those days was selling for something like maybe 3 to 4. The IT industry in those days was about 4 to 8 times profit at the very dream level. We ended up selling for 12 times profit on future profit, which was just, and we were growing at something like 30% a year. And so that was just a phenomenal multiple and all the rest. We didn't know what we would get until we put the market out. So the way the accounting firm that helped sell us in the first stage, they put out to the market and say, what would you pay for this? And we had a range of offers. Well, in that first offer, so this is a failed one before I negotiated myself with the multinational, but those offers came in between 2 and 8.5 mil. So the 8.5 mil was a big accounting firm that wanted to buy us out. And but we had no idea. And as I said, 2.5 years before that, maybe 3 years most before that, I was sitting on the balcony with my wife. And remember, I was a poor kid that started the business with no money, no cash, and built it up. And I remember dreaming that one day we might be able to sell the business for $1 million, and just imagine and joking about it. And then, literally 3 years later, we get an offer for $8.5 million for the business. And then we sold it for almost double that in the end. Now, there's another side to the story as well, is that even though we sold it for a great deal of money in the end, we didn't receive all the money because of what happened post the contract. But it's a really interesting story. The second time round, however, we approached. So I tried to sell the business myself, and I had a fair idea of the valuation. I had 3 failed attempts at trying to sell it myself. Not because people didn't want to buy it. Everyone agreed to the price. They thought it was a great price. I was happy with it because I knew exactly where I was from my financial perspective. It's fantastic business. But when you're trying to sell yourself, there's no sense of urgency. They can keep screwing you or deadlining you. And when it came to paying the money in all 3 cases, then just the money didn't arrive. Now, so what I did was I ended up going back and getting a business broker from the US. And these guys were really professional, really good. And we agreed on a valuation to the dollar on what it was worth. They sell literally thousands of businesses. They said, this is what we're going to go out and get. This is what we're going to put on the market. This is where it's going to come down to, and that's what we're going to end up with. And I said, okay, let's do it. Within 6 weeks, we had 5 offers for the business. And within 2 months, we had the business sold.
I'll reflect on a couple of things. You mentioned that the market was talking between 4 and 8 times and you ended up getting 12. Do you think that was a factor of you doing that reverse due diligence and really getting your business fit and ready?
I think that was a dual factor. So the first is it was a frenzied market. And all our competition out there was non-bricks and mortars without a substantial business. And what we brought to the table wasn't just the money that we had, it was the volume of clients and inquiries we had that could then add to somebody else's business. So when you're brought out by a multinational, it's not just how big your business is, it's what your business can do to their business. And in this case, the multinational was dealing in 30 countries around the world. So whatever they paid for us was peanuts to the amount of money they could make by distributing our products, our services, and also what we knew to the 30 countries around the world. Okay. But it certainly did help. Having said that, when somebody looked at us, they knew that we were a business of substance that wasn't going to cause them headaches, and we were at a premium, what I call an A-grade business. And, that's where we drove to be. I reckon we would have been a B or C grade business when we started working on the preparation to exit, and we end up being an A-grade business. And that determination, ended up in a good valuation in the end. Yeah, sort of increased that multiple. Another point you mentioned in your discussion was that in the first sale, you ended up selling at this fantastic multiplier, but you didn't receive a substantial amount of those funds. Is there a learning or a takeout on that? And how did that evolve that you could do better? Absolutely. Look, there was a great takeout. So being your total, we'd grown at 30% for the last 3 years prior to sale. And so when you get taken out by a multinational, they're in 30 countries around the world, they've got 30 sales reps and you've never had any, then you've got the expectation that those numbers are going to continue to rise. What happened was the market turned quite dramatically. The multinational had 30 sales reps and cut back expenses and ended up having 2. There was their salespeople weren't commissioned for selling the acquired companies, our company's sales. And so the whole lot was just, we were an innovative company, and instead of producing 6 new products a year, we were lucky to produce 1. And so the whole model changed. We were stuck with expenses in our profit and loss like you wouldn't believe, Simon. Like when you go from a small business and then suddenly the multinational says there's a 20 grand audit fee or a 30 grand fee for this, and you think, what? And so that all combined to make it almost a catastrophic multiple in the end. Lucky we were protected by minimums, and then there was a little bit of a legal, contentious issue in which we decided to settle on a certain amount,
Would you have taken the money in a different way? Would you have taken a lesser earnings and a quicker exit?
Yep.
Yeah.
So at one stage, because they knew that we were offered $8.5 million before by the accounting company that fell through, and by the way, that fell through in due diligence because the accounting company went and paid $30 million for another company and didn't have the cash. So we were offered that $8.5 million in cash, or the 17 in projected earnings. I took the 17 in projected earnings because I thought it was a lay down misere. I wish I had taken the 8.5 in cash, in the end. But so your whole everything that you think, it may change because of circumstances. And you've got to either go, you're either positive or not. It could have worked out fantastically, and I could have managed it a lot better too. That I just trusted too much. And I accepted stuff and I didn't question it, didn't argue with it, and just thought everything was going to be all right, and it wasn't. So, so there's a lot I learned, about and probably being more mature. I was young, I was 39 when I first sold the business, and probably not that mature in terms of dealing with multinationals and things that I should have expected. I just didn't know.
And probably that's a factor of the advisors at the time that you probably relied on, or we could have relied on, for giving you a bit of that knowledge and skill. Once we've started to receive the funds and we've got a bit of planning, and you've obviously got some golden handcuffs attached to those funds with multiples on earnings, what happens to you financially in that process? Do you just take the money and put it in the bank? Where were you going with that?
Yeah, well, look, in the first stage, when I first sold the business in let's talk about, Business One, which I sold. So I've still got a great lot of cash up front. So there's a great deal of cash up front, and I got a second payment for the balance or whatever. So there's a great deal of cash up front, which came straight into the bank. I had the mentality then of saving money that cost me money. So I didn't talk to wealth planners, financial planners, and I thought I was clever enough to manage everything myself. And what happened was I went from a risk taker, Simon. Remember, as I said, I was like a poor kid that sort of finally had money. So as a young kid, we moved houses all the time and we rented a house. We didn't own. And then finally, when I got all this money and we'd paid off our house and I was sitting there, I became like risk averse, and I was too scared to put it over here or over there. And, I didn't want to spend money because I still trained from those early days of not spending money, of really getting some good advice. So I've got to say I didn't manage the money well in the first place, and I never got personal advice. And the interesting part was the second time, as I probably matured more and started the second business and got close to starting to think more about retirement and, what I was going to do with this business, that I went and saw a financial planning company. And funny enough, Simon, that was you guys. And that was Navwealth. And one of the things that I remember talking to you, and we were talking about the tax planning side and talking about concessions that you can get and talking about getting the business ready, which was absolutely phenomenal. And then you suggested that I talk to your financial planner person in there as well. And I sort of thought, oh, do I really want to? And in the end, I said yes. And, that was the best thing I think I ever did, because the start of that conversation was about what I want, but then can we also talk to your wife? And can we get a feeling? And having Lou in that office as well and talking about the type of person I was and whether or not I could retire and how much we needed and all the rest was absolutely phenomenal. And then putting together that plan, which was a thorough plan, and it connected. And what I really liked about what happened in the meeting was that you had the tax planner specialist, which was Simon, and then you had the financial planner, and you guys were just going off each other, like, hey, what if we got that concession? Yeah, but you can't get that because of this and that. And I thought that combination of the two linked with, it was all revolved around me and my priorities, but it was just fantastic, and you just felt that you had a good outcome. And I think, like any business owner, you really sometimes need to be told, look, I know you think you should do that, but have you considered this? This does sound sensible. When I looked at the plan that we had in place, it was just fantastic. And to me, I would always recommend, so I wouldn't recommend going to see a financial planner in isolation necessarily, unless you know that they're good and they understand what a business owner and how a business owner functions and the tax side. But I would highly recommend that you find a firm that's got a financial planning arm and a tax planning arm that understands business owners, understands what's their needs, because the needs of a business owner is completely different to the average, sort of person that's just, being employed in a business.
Yeah, fantastic. And thanks for that, Pete. I really appreciate that feedback. I've only got one more question in the series here. And for anyone out there who's in business and is thinking about maybe selling one day, and I suppose that's a reason we are in business, to extract value at some point. How far out do you think this planning, or how far out do you think we start to plan to sell our business?
Every business should be planning with the exit in mind. And, it sounds like theory, but really your business model. The most valuable businesses are ones that have got recurring revenue, subscription revenue or whatever. So your business model really needs to revolve around what you can sell. Your lifestyle as a business owner, if you think about how can you build a business that's not reliant on yourself, I think that's really, really important. Too many business owners have got the core skills, but can you migrate those skills to other employees to continue the growth of the business? If you're starting a business in a small market, will you ever be able to sell it? So planning to sell a business should start from the beginning. Now, let's just take it that you haven't. You should definitely plan at least 2 years out. And the reason for that is, longer if you can, 3 years would be great, but and the reason for that is that sometimes you might have to change a legal structure. And it's very difficult to do that the day before you sell, but you can do it 2 or 3 years out perhaps. Sometimes you're going to have to plan on changing your model or making the business less reliant on you. If you set the business up with, in my case, Peter Hickey and Associates, then it's going to be very difficult to sell because no one wants to buy a business with your name. So, even if it's Hickey Plumbing or Hickey Electricals. So changing a brand name would have to happen many years out. If you've got, if you've got employees without, proper employment contracts, then to go to them the day before you sell and say, can you please re-sign this, is always a bit of a difficult conversation to have. The same way if your relationship with your partner isn't good. If you're struggling in your relationship with your partner, a divorce is inevitable or a separation, then to try and build the business to the maximum amount right now, it might be better to negotiate, out of the business before you go through this value creation. So there's all sorts of reasons why at least, have a look, 2 to 3 years out at all these things, and even have a conversation with the business broker. Start educating yourself on what is value of a business. How do I grow the value of a business? And I think that's going to make you a better business owner and build a better business.
So I've got some really key takeouts on that, and thank you. And in summing up, the value of the business is critical. Know what the value drivers are, or the value of that business early. Get that reverse due diligence started, and that will extract all these facets in your business. I liken it to a ship that's got leaks in it. The reverse due diligence will isolate those leaks and allow you to plug the holes. And every time you're plugging a hole, you're increasing that value. So if you know the value now and maybe check in on that value using the same metrics every year or two as you're planning out, you can watch that value grow as you fix the business.
Absolutely. Yeah.
And if you start that process 2 to 3 years out, you're more than likely to get it right and not cause you any angst when it comes to that final day.
Yeah, absolutely. Yeah.
Fantastic, Pete. I really appreciate your time. This has been wonderful. And any final takeout for someone who's thinking about selling their business?
I think selling a business is a dream, and I think, but it's within the reach of everybody if you plan for it. And 20% of business owners will effectively sell their business. 80% of business owners that get listed on the market actually don't sell their business. And one of the reasons for that is that when somebody looks at that, those business owners, and they start having a look at the business, they say, well, that's a rubbish business. So planning really is going to help you to be one of the 20% to be able to sell successfully. And wouldn't it be great? You work hard. You don't pay yourself often as much as what you could elsewhere. You work harder than anyone else, but you build a business to have a dream. And wouldn't it be great if we could complete that final chapter for that dream?
Oh, fantastic, Pete. And once again, I thank you for joining us today, and I look forward to our future discussions.
Great.
Thanks for joining us today for NavTalk. You can listen to other podcasts in the NavTalk series via YouTube or where you get your favourite podcasts, or simply search NavTalk. Be sure to follow Navwealth on LinkedIn, Instagram, Facebook or Twitter. And please, if there are any particular topics you would like us to cover for a future episode, let us know via our website. I'm Simon Prowse. Until we talk again.